Welcome back. Today's lesson will be on bank statements. We'll be learning how to calculate the present balance on a checking account bank statement. Basically, what a bank does to see how much money they think you have in your account. A bank statement is some mail that you get from a bank that tells you a list of all of your transactions since your last bank statement. So you get one like a month after you open up the bank account, and then after that you always get one each month that just tells you here's how much money the bank says that you have in your account right now. Now this should match what you have in your check register, which we discussed last time. The bank account might have the bank statement might have some other terms in there though. They might charge you what's called a service charge, a fee the bank charges you for a service that they provide, such as automatic bill pay. The bank will also record for you how much interest you are earning. Interest is the amount of money paid for the use of money. Remember that ultimately the whole reason that you're putting money in a bank is so when you do that, the bank actually uses your money. It doesn't just sit there. The bank uses your money to give other people loans. Now, if you get out a loan from a bank, you have to pay the loan back, but you also have to pay extra money back to the bank. That's how the bank makes their money. On the other hand, because the bank is using your money and to give it to other people, they will actually pay you some money so that you're earning money just for having your money at that specific bank. The way the bank makes the money is they charge a higher interest rate for people paying back loans than they give to you for interest for keeping your money at the bank. So the extra money goes to the bank. That pays for the bank. So interest in this case, if you own the account yourself and it's a bank account, when we're talking about interest, that's extra money that you're getting. That's good. Now for some other types of accounts, like a credit card account where it's not actually money that you have, but it's money that you owe, interest is bad. So we need to know what type of account we're talking about. In order to figure out how much money is at the end of the bank statement, we have to do some math. The amount of money in your account at present is equal to your previous balance, whatever it said on your previous account statement, plus any deposits, because that would make you have more money, minus any withdrawals, that would make your account have less money in it, minus any service charges, any charges for fees that the bank provides, or any fees for services that the bank provides, plus interest. If you look here, you're adding things that would give you more money, you're subtracting things that would take money away from you. It's that simple. We're just going to get right into the examples. Thomas Heath's bank statement for December lists deposits of $17.54, $78.22, and $459.28. What are his total deposits for December? We just want the total deposits. That means add these up. $459.28 plus $78.22 plus $17.54. The total of his deposits is $555.04. Very straightforward. Let's throw a couple different types of transactions in there. Juanita's bank account for May shows a previous balance of $658.34. That's the previous balance. Her total deposits for the month were $841.77. Her total withdrawals were $930.74. She received $2.44 in interest. What is her current balance? Before you do any math, think, which of these amounts of money is going to increase the amount of in her bank account, which are going to decrease the amount of money in her bank account. If she's making deposits, she's putting more money into the account. That's a number that should be added to the previous balance. Withdrawals are opposite. That's going to take money away from her account. And $2.44 in interest, well, interest, since she's keeping her money at the bank, they're paying her to do that. That's going to increase the amount of money in her account. So I take the previous balance, I add the ones with a little plus sign under it, I subtract the ones with a minus sign. And that's all you really have to do. $658.34 plus $841.77 minus $930.74 plus $2.44. Make sure you just have the right plus or minus sign, that you're actually adding the things you mean to add and subtracting the things that you mean to subtract. Her new balance should turn out to be $571.81. Another example, your bank statement shows a previous balance of $1,045.97. You make deposits, those will get added, of $845.50 and $178.40. You write checks for $465.50 and $987.95. Writing a check means you're losing that money. It's going out of your account. So these must be subtracted. You have a $3 service charge. That means the bank charged you for something that you had the bank do for you. So that means you're going to lose that $3. And you earn, means gain, 25 cents in interest. What is your present balance? Hopefully you see that this is very straightforward. You just need to know, and you always need to be asking yourself, will a certain activity increase the amount of money in my bank account or decrease the amount of money in my bank account? And I really do urge you on this one to please double check these calculations after you've gotten them all written out. It is really easy to add something that you meant to subtract, or otherwise, to subtract something that you meant to add, or to just hit a wrong number on the calculator, and if you don't check, you'll never know. So it's really easy math. Please check your work. In this example, your new balance should be $613.67. Two more examples. Jerry Summers' bank account for January lists withdrawals of $65.34, $23.61, $629.60, $72.82, and $124.41. What are his total withdrawals for the month? So I know withdrawals it's decreasing the amount of money that you owe, or it's decreasing the amount of money that you have in your account, but we're looking for the total withdrawals. If we had a previous balance and we were looking to find the new balance, we would subtract all those. But if we're just looking for the total amount of withdrawals, I'm just going to add all those together. The total amount of all these withdrawals is $915.78. Finally, your bank statement in May showed a previous balance of $2,741. You made deposits, gaining money, of $78.90 and $87.41. You wrote checks, losing money, for $35.72 and $97.68. You used your ATM card to withdraw, meaning you took money out of your account, $30 and $80. Your bank charged you a service fee of $5.75. They charged you money, so that's less money than you used to have, and paid you interest, meaning you gained that money, of $5.24. What is your new balance? Starting balance, add the things that have plus signs, subtract the things that have minus signs. If you prefer to do these a step at a time, that's fine. If you prefer to do this all in one row, that's also fine. Just make sure that you don't mess it up. Your new balance should be $2,663.40. So reading bank statements is pretty straightforward. In our next video, we're going to look at how to reconcile a bank statement with your check register. In other words, make sure that they say the same thing and agree on how much money you have. Because if they don't, that's not going to go very well for you. Talk to you later.